Hello and welcome. My name is Marius and I want to talk about AI in the context of a low-growth world. I think we all normally like to think about AI and what it can do for us, and it's usually quite far in the future. Today, I want to talk about what AI must do for us and be careful to start at the present starting point. Where are we right now? What do we need right now from AI? See, even if just for the sake of a thought experiment, it is becoming unfortunately easier over time to argue on the side of a lower return world going forward. Global demographics are in quite a bad state. We've enjoyed low interest rates for a very long time. Global debt is far too high. And we're likely to contend with these issues against the backdrop of a deglobalizing world, a world of disunited nations, if you will. All of these themes have powerful implications for pension systems. I introduce AI as a lonely tailwind amongst many headwinds and try to draw some careful conclusions on how we can prepare our members. What do employee benefits and pension systems even look like in a low-growth world? This industry is always very focused on risk, which is good, but we have to acknowledge that markets have been actually very kind to us lately. The post-COVID environment globally, combined with the GNU rally in SA, has pushed most funds far ahead of what trustees and mancos likely targeted and expected. The implication is that if we are buying the same ideas, we're buying them currently at high starting points, and it will be difficult to eke out a good return from here. From this current high starting point, the global economic pie is no longer expanding either. If we face the challenges of demographics, interest rates, and debt levels against a backdrop of deglobalization, growth will likely suffer and pension funds simply have to adapt. The assets that all our portfolios buy into are anchored in the long term by growth. And a big part of growth is having babies. If you go to work every day, you expect to get better at what you do. But if we just think of GDP growth as how many people are using how much capital, how productively, then it's clear that losing workers likely means losing growth. Maybe more holistically, we have to think about what pension systems look like, where more people withdraw than contribute over the long term. What happens, for example, when rich nations kick a big debt can down the road to a smaller generation of people? To South African stakeholders, some of our foreign investors will be anchored in saving systems with net withdrawals over time. And our global strategies will have to adapt to this demographics theme as well. Japan is always a good example. We've only ever really known agricultural societies with many kids and fewer old people. In recent generations, we've witnessed a pattern where industrialized nations' demographic pyramids turn into columns, with equal amounts of older people and younger people. Now, many developed markets are seeing inverted pyramids, with many old people, and in some cases, barely a follow-up generation. Japan was one of the first countries to go through this, and it led to 30 years of flat Japanese equity market returns. Will demographics continue with this current trajectory? Unfortunately, yes. And what's the implication for growth? Adjust expectations downward. Now add to the demographics problem that interest rates have been falling for the last 40 years. This has been a tremendous tailwind for retirement portfolios, with now not much space to go down further, but a lot of space to go up. And the low interest rates went along with an unfathomable amount of debt. Take a moment to guess how long ago in days 1 million seconds was. It was about 2 weeks ago. Now, how long ago was 1 billion seconds? It was 1993. Now, how long ago was 1 trillion seconds? It was about 30,000 years ago. Global governments are about $100 trillion in debt. And this means there's less capacity to spend, rescue, and intervene in the future, along with a whole host of other issues. And these 4 headwinds put together leave a lot of complex open questions. And one of the very few answers is artificial intelligence. AI could add about 0.6 to 3% to equity returns and reduce bond yields through productivity gains. If we think of the historical context, productivity in the US was strong post-World War II and then slowed. In the 1990s, the tech investment drove a rebound, and this party is starting to feel a little bit like the 90s. That's why, from a portfolio perspective, we think the right way to get exposure to the AI theme is through something versatile, something like the FANG AI actively managed ETF that can avoid the losers as much as it sticks with the winners in this AI era. We've also seen strong success stories in the past and in process with operational efficiencies and predictive analytics offering genuine evolution. But let's tie all of that big think back into the bedrock of our South African industry. If we measure, for example, by National Treasury's 2014 proposed retirement reforms, there's been great progress in a couple of areas. Preservation has been addressed point blank by Two-Pot. Defaults, where visible, are in a good place overall, taking good care of members who do not exercise choice, and consolidation attempts have worked. And this leaves coverage and costs as some interesting outstanding action items. In terms of coverage, we know, for example, that about 30% of formal South African workers are not participating in a retirement fund, and that auto-enrollment presents an interesting proposition for this to change. The details of such a future are obviously difficult to guess, but we could imagine a new market segment with demand for highly digitized, slimmed down, low or no intervention type of solutions. This area will likely require new levels of operational efficiency across the industry to stretch previously unpensioned individuals' contributions as far as possible. And this places an extremely high burden on efficient financial technology solutions that get that job done for less and reduces retirement in some major sense down to a financial technology challenge. In such an environment, we can picture much higher levels of digital engagement, much more standardized and centralized member communication, and much more emphasis on economies of scale and positive externalities. Low-fee solutions are critical to true progress in coverage, and any enhancement in fee disclosures should probably not be too surprising either. The combination of efforts in coverage and cost effectiveness, or at least simplified transparency in charges, represent great pillars of progress in the pension fund landscape for South Africans. They also represent a tall order for providers and an extremely high burden on innovation in financial technology. The elegance in the combination of all these ideas might be that they posit growth as the common element between our investment returns, a lot of our EB operations, and even a little bit of our regulatory environment. We come from a place where global growth has been fairly good in retrospect, and market returns have been much better. The themes we've rediscovered today leave us with lower growth forecasts in most instances, And if we compare our lower growth hypothesis to historical patterns, we find that the data corroborates our suspicions and suggests that forward-looking expectations should be adjusted downward. The findings include that growth assets that the whole world's portfolios depend on may be limited to high single-digit returns, and this leaves us with a couple of crucial points that we have to get right in the next cycle. In a lower growth world, lower fees are critical. AI must help us here to continue to innovate and keep as much of members' money as possible in the funds and growing. A passive portion in long-term portfolios is of course a great way to achieve this, but even when blending with a bit of active management, the right fee for the right type of thing is critical and can make a proportionally larger difference in retirement outcomes over time, especially if growth is scarce. Proactive risk management takes on a holistic global risk framework. We prefer to do this via tactical asset allocation, as this type of framework allows us the degrees of freedom to navigate an evolving global environment. And exposure to diversified sources of return is paramount. Thematic equity investments allow investors to capitalize on long-term structural trends that provide pockets of growth in an overall low-growth world. Deglobalization, demographics, debt, and interest rates are all conspiring against investors. Structural macro headwinds will prove challenging for all asset classes. Long-term return assumptions must likely be lowered, and that flows through to implications for all stakeholders. A lower growth world places pressure on delivering value for the right price and managing also expectations on key variables like working years, risk product design and take-up, and contribution rates, for example. An exceptionally high emphasis must be placed on process efficiency, operational resilience, and excellence. And for some segments, the entire retirement savings journey could very likely be approached almost purely from a fintech lens. Finally, the regulatory backdrop is set to focus likely on coverage and costs, a message that actually runs congruent to the type of thinking needed to prepare for efficient retirement solutions in a low-growth world. It therefore is time to make the shift of thinking from what AI can do long-term to what it must do right now, and time to make AI less artificial and more intelligent.